Okay, hello, welcome to another weekly live. Okay, so for today, I'll be doing an earnings review of a few major companies, basically the four major US banks and also TSMC. Okay, so now let's dive right into it. Let me just check the stream first. Okay, good. Okay, so let's go with the first major US bank. So CitiGroup, as you all know, recently they cut a few jobs from their main company. So they're expected to cut about 20,000 jobs over the next 2 years. So basically from now until 2026. So out of these 20,000 jobs, right, 5,000 of it are managerial positions, while the rest of the 15,000 are actually your normal staff cuts. So all these job cuts, right, are part of Citi's efforts to actually streamline their operations and also to cut back on operational costs. So if you look at Citi's full year results, right, you will see that their expenses are actually around 54.3 billion for 2023, for the whole of 2023. So for the next 2 years, right, their main goal is to bring down this expense to around 50 billion. So yeah, as you can see, the job cuts will also save about 2.5 billion in expense. Okay, so moving on to so if you look into a more in-depth view of their expenses numbers, you will see that compensation and benefits actually is the highest for the full year 2023. So that it kind of makes sense for them to actually go after this number and try to reduce it as much as possible. So besides salary and compensation benefits, the next major line on their expense amount is actually the operating expenses. So this is also why CitiGroup, right, is actually looking into streamlining the whole process to actually cut down on this number also. Okay, so in terms of actual results wise, Citi reported 17.4 billion for fourth quarter 2023, which was a 3% drop from the previous quarter in 2022. So net income came in at a loss of 1.8 billion, mostly due to net credit losses and other things I'll go through later. So in terms of financial ratios wise, they still remain pretty much quite strong because their common equity tier 1 ratio is still quite high at 13.3%. So in terms of financial health wise, not much worries for Citigroup. Okay, so if you look into their financial statement for the full year FY 2023, you will see that their net credit losses is about 6.4 billion. So this one means that Citi actually parked aside this amount of money for certain reasons. So the two main reasons for this is the devaluation of Argentinian pesos and also write-backs of certain losses with investment in Russia. Okay. So moving on. Yeah, so we look into there are 4.7 billion of expenses. This one shows a breakdown of it. So you can see that 1.7 billion is due to the FDIC assessment charge. This one is related to the shutting down of banks such as Silicon Valley Bank and also First Republic Bank back in 2023. So this one is a regulatory charge, so there's not much they can do about it. Then this one is, yeah, so this 1.3 billion you see here is due to the Argentinian peso devaluation and also Russia investment cutback. So in terms of trend-wise, if you look back at the past 5 years for CitiGroup, if you look into their revenue and their net income, right, you will see that revenue has been increasing at a rather low compounded annual growth rate of about 2% for the past 5 years. And then you can see that over the past 5 years, it's not a inclining increase. It's more like a up and down thing. But the main, my main concern about CitiGroup, right, is the net income. You can see that it has been decreasing quite drastically over the past 5 years, which is also why they plan to cut back on staff costs and whatnots. So moving on to their growth prospects for the next 2 to 3 years, honestly, I do not think it's very healthy, because if you look at their individual business revenues, right, only 2 revenues is having a compounded increasing growth rate. So services and US personal banking. The others like markets and also wealth management are all down for the past 3 years. So so moving forward, right, what can grow Citi's revenues are basically increase in loans for credit cards, and also having a bigger market share of deposits and loans. But if you look into Citi's projection for the next year, you will find that they actually increase their provisions for NCL. So NCL basically means net credit loss. So they're projecting net credit loss trend to actually increase to 4%. So meaning that there will be a higher percentage of people defaulting on their loans, on their credit cards. So this means that Citi as a group might have to actually park a bigger sum for NCL for next year or so, which will mean that they will which will also negatively impact their net income amount. So if you ask me, personally, I wouldn't invest in CitiGroup because this year there will be rate cuts. I mean, most likely there will be rate cuts for this year, which will eat into Citi's net interest income. Furthermore, they're also predicting a higher NCL for loans, which means that their expense will also go up. Although there might be some savings from staff cuts and company restructuring, but I don't think it will it can provide much upside to their bottom line. Okay, so moving on to the next bank, Wells Fargo. Okay, so earnings wise for 2023, their net income came in at 19 billion, which was an increase from 13.68 billion for the past year. So if you can see, their net interest income also increased from 44 billion to 52 billion this year. Same goes for non-interest income. So overall, not too bad a result for Wells Fargo. So in terms of trend, right, sadly, both their revenue trend and net income trend is negative compounded annual growth rates of about 1% for revenue and about 3.9% for net income. If you look deeper into their financial statements, you will see that actually for the past few quarters, their net interest income is actually decreasing quarter on quarter. So this one is March 2023 all the way till December. Okay, so what is saving their revenue? Actually, their slight growth in non-interest income. Things like investment advisory, and also other things like mortgage, like basically more towards investments and trading activities. So based on their expenses wise, their biggest expense is of course their staff, and then others Yeah, and also others. Okay, so if you look at the trend for Wells Fargo, right, their net interest income yield is actually decreasing quarter on quarter. So from 3.14 in fourth quarter 2022, all the way down to 2.92 in fourth quarter 2023. So with rate cuts coming in this year, you can expect this ratio to continue decreasing over the next 1 year or so, which will also negatively impact their net interest income. So with that said, I expect this number to actually decrease over the next few quarters, which will definitely impact their revenue here and also their total net income. Okay, so in terms of what's their growth drivers for Wells Fargo, it's basically more towards corporate and investment banking. As you can see, it's up 14% year on year, but then quarter on quarter is down 4%. So this will be Wells Fargo's main focus for the next 1 year or so to actually grow this amount, to actually try to prop up their net interest income. Okay, moving on to the third bank, Bank of America, or BOFA for short. Okay, earnings wise, results wise, a small increase from last year, and then net income dropped from last year. So in terms of trend wise, total revenue for BOFA has been increasing about 2% for the past 5 years. And then in terms of net income, is down 1.45% or 1.5% in you're rounding up. Okay, so looking into their financial statements, you can see that similar to Wells Fargo, their net interest income is actually decreasing quarter on quarter from about 14.4 billion in the beginning of the year down to 14 billion in the fourth quarter. Then in terms of non-interest income, much of it comes from their fees and commissions. So this one is basically linked to their investment and wealth management fees and also advisory fees. Okay, non-interest expense wise, similar to other banks, much of it comes from their staff. And also, so surprisingly for Wells Fargo, right, they actually spend quite a bit on equipment and technology. But whether it will help their top and bottom line remains to be seen. Okay, so if you look into their non-interest income, much of it will come from their card income. So basically things like fees for credit cards, annual fees, late charges fees, and whatnots. Okay, as mentioned earlier, much of their non-interest income is really due to the advisory services. So asset management fees and brokerage fees. So investment related and wealth management related. Okay, so Wells Fargo's plan, not Wells Fargo, BOFA's plan to actually grow their business for the next year or so is to focus on their loans. Focus on growing their loans amount. Okay, so if you look at their trend for the past few quarters, to be honest, it's not very impressive because you can see that year on year it's actually up 1%. But in commercial side, it's also not much changes. So I do not know what's their plan to actually continue growing their loans. But on the bright side, business-wise and loans and leases in business actually increased 9% for global markets. And also for other things like consumer banking, global wealth management service, and global banking all went down. Except for consumer banking. Consumer banking was an increase over the past 1 year. So yeah, so to be honest, I don't know why they're focusing on growing their loans, because trend-wise it's not very healthy or favorable for them. So the other way for them to actually improve their businesses, actually to grow their deposits account also, the amount of deposits. Because for banks, right, the more deposits they have, the more cash they can have to actually invest in higher yielding investment instruments. But of course, they also have to give out more interest to their consumers. But most of the time, the investment yield or the investment return will compensate for the deposit that's being given out. Yeah, so as you can see here, this is BOFA's expected investment return for their cash and securities, and this is the rate they give to customers. So there's a difference of about 1.7%. So as long as BOFA can get more deposits in, and then maintain or even increase this yield, there's a chance they can actually grow their businesses from this difference in spread here. But if you take note that with rate cuts coming in, right, the potential of rate cuts coming in this year, this ratio here will actually drop because your treasury investments yield actually drop also. Okay, so now on to the last bank, JPMorgan Chase Co. Okay, so JPMorgan wise, their results are quite impressive, because you can see that revenue increased by about 21.9 billion. But do note that much of this increase was due to the acquisition of First Republic Bank back in March 2023. So yeah, net income also increased from the previous year. So if you take away the acquisition of FR, right, you will see an increase from the previous year, from 45.4 billion in 2023 as compared to 37.7 billion in 2022. So in terms of trend-wise, as compared to the other three banks earlier mentioned, this is the only bank that actually increased both their revenue and net income for the past 5 years. But of course, this amount is due to the acquisition of FR. So if you remove it, it's still an upward trend from 109 billion in 2018 to about 128.7 billion in 2022. Same goes for the net income. So if you combine, so in total, composite annual growth rate for net income is about 11%, and then for revenue is about 9.74%. Okay, so look deeper into the financial statements. As mentioned earlier, net revenue increased from last year. Much of their revenue comes from their principal transactions. So basically, I suspect this is related to their FR acquisition. And then after that is asset management fees. Yeah, so basically their investment related and wealth management fees. Expense-wise, as usual, staff costs the highest, followed by their own professional and outside services. I don't know what this is, but yeah. Okay. So in terms of growing their business for the next 1 year or so, they expect their growth in net interest income to be quite modest, because they are pricing in a total of 6 rate cuts in 2024, meaning that they're expecting the yield to drop to 4%. The Fed interest rate to drop to 4% from 5.5 currently to 4% by the end of 2024. So they're expecting about a drop of 8 billion in revenue, in net interest income, but then will be slightly compensated by growth in their balance sheet and loans. So basically, it's quite a negative outlook for the next 1 year, for this year. Basically, mostly down to the rate cuts. So expense-wise, there will be an increase in expense, a projected increase in expense to about 90 billion for this year, from 85.7 billion. Okay, if you exclude the FDIC one-off charge, will be 86 billion, and then to 90 billion. Okay, so if you look at all four major banks' earnings, right, these are the few takeaways. So all four major banks, their net interest margin is actually decreasing or tightening, meaning that their deposit rates and their yields from investments, from safe investments, is decreasing. So this means that net interest income will come under pressure in 2024. So if you factor in, so most banks are actually factoring in 6 rate cuts for this year, and then most of them are also expecting a soft landing. So soft landing basically refers that interest rate will come down, but then the economy will not suffer and will still remain either growing or maintaining at current pace. So meaning that we no recession in that sense. So if this happens, right, if you really see 6 rate cuts and a soft landing, there will be growth in investment related and wealth management services. So why is that so? So we think about in terms of risk allocation, right? If rate cuts to happen, if 6 rate cuts happen, that means our interest rate will go down to 4%. So which also means that your risk-free yield will also drop, meaning your treasury yields also drop. So once treasury yields drop, individuals or affluent clients, right, will want to have an avenue for higher returns on their cash. So they'll be forced to actually look for opportunities in the market, be in real estate, be in equities, or even bonds. Yeah, so with that, right, they will approach banks to actually help to actually invest their money with the bankers. So yeah, so as long as rate cuts happen, investment related and wealth management services will most likely increase. So with that said, I expect bank revenue and net income to actually either remain quite steady or actually drop for this year and the next due to the prospect of the 6 rate cuts. So yeah, that will be all for the 4 major banks. So moving on to the last company. So this one is TSMC, or basically what the long form name is Taiwan Semiconductor Manufacturing Company. So this company actually makes most of the chips in your smart devices, in your smartphones, or your other devices like your smart home devices. So yeah, for 2023, they actually reported a drop in revenue as compared to 2022. So I'll explain to you why in the next slide why this is the case. So, but if you look at other metrics, right, free cash flow also decreased, but then they're still quite financially stable. But ROE is also quite high at 26.2%. Okay, so why did that revenue? Okay, so in terms of trend-wise, if you look at their past 5 years trend, net revenue increased by about 20% over the past 5 years. And then net income increased by about 24% for the past 5 years. So if you look at everything as a whole, it's actually quite an impressive growth rate. Okay, so to address why their revenue dropped for 2023, much of it is down to their 3nm technology production. So in 2023, they were actually scaling up this production, which means that there was lesser production activity for both their Nano 5 nm and 7nm wafers. So as you can see from this chart down here, let me just take away this pen. Okay, so as you can see for 2023, you will see that there was a drop in both 5nm and 7nm production. and then in 2020, in third quarter and fourth quarter, there was a rise in 3nm. So 3nm is their latest technology, but then for now in the market, there's not much products that use a 3nm technology. So mainly only Apple uses 3nm for their new iPhone models. But then if you look at things like smart home devices, GPUs, all this, right? Most of them use either 5nm or 7nm. Okay, so if you look at as a whole for the 2023 to 2022, much of their revenue comes from their 5nm. Okay, so 33% as compared to 26%. So the reason why this is so is because 5nm, right, is the main chip for most AI GPUs. So as you all know, nowadays AI is a new it's a growing technology and so growing industry. So demand of AI GPUs rise. So most of them are actually using a 5nm technology. So if you look at TSMC 2023 revenue by segments, right? You can see that so HPC basically stands for high performance computing. So this is basically your AI, your cloud computing, and also machine learning. Then smartphone is smartphone. Okay, so in terms of why these two are the biggest contributors, is because TSMC, their biggest customer, the two biggest customers is actually Apple and Nvidia. So Nvidia, as you know, is a leader in AI GPUs, and then smartphone is Apple products are actually one of the major market leaders. But if you look at growth rate wise, you will see that smartphone actually decrease year on year. This is quite normal because smartphone demand, right, is due to seasonal demand, and also a lot of it is based on consumer spending. So if consumers do not spend much on buying new smartphones, then there's not much demand for TSMC to produce chips for smartphones. Okay, so another thing to note is there's actually a growth rate in chips used for automotive. So if you ask me, right, I feel that this could be the next growing industry. Because if you look at Nvidia's CES stock that actually ended last week, they signed multiple deals with vehicle manufacturers like Mercedes-Benz, all this. It's to actually drive the next wave of automotive vehicles based on driverless technology. But whether it will be successful or not, it remains to be seen. But then based on the growth rate by TSMC, year-on-year growth rate, I think it's quite a promising sign that there could be growth in the automotive industry in the next year or so. So in terms of look at their revenue drivers or the revenue segments, you'll see that much of it comes from their 5nm and 7nm. But in terms of geographical revenue, North America takes up the most, at around 68%, and then China is about 12%. So if tensions between Taiwan and China escalates, right, you can expect this potential revenue, this potential contributor of revenue from China to actually drop from 12% to a lower number. So in terms of growth prospects wise, TSMC is actually looking into ramping up production of N3 wafers for this year. So you can expect their gross margins to actually remain quite modest, either remaining steady or decrease by about 3 to 4 percentage points. But another way they want to actually utilize or increase their N3 capacity to tap on the current N5 tool. So basically means that technology that is used for production of 5nm can also be used for production of 3nm wafers. So this will actually improve efficiency and also help to actually not make the drop in revenue that drastic. So yeah, that will be all for this live. Yeah. So yeah, just a quick look at all the 4 major banks and also TSMC, their fourth quarter earnings results. So yeah, for the next weekly live, I'll be touching on a few companies, basically Microsoft, Netflix, Tesla, Intel, and also Keppel DC REIT. So if those companies interest you, do catch the next weekly live. Same thing, Friday 8:30 p.m. So I will see you all then. Bye bye.